All right, ladies and gentlemen, it is FOMC day. And you know what that means? We're live early because we're going to be covering right here on the Tim Warren Show live at 2 o'clock Eastern Standard Time. We will get the announcement from the Federal Reserve. What are we doing next? Are we going to keep rates paused? Probably not. Are we cutting them by 25 basis points? Are we cutting them by 50 basis points? Are we cutting them by even more? That is the question at this moment. We always tell you this is the most important FOMC day that we have yet seen. And this time, that's actually kind of true because every other FOMC meeting up till today, at least in the calendar year 2025, has been pretty obvious what's going to happen. Yeah, we get our hopes up about the next FOMC meeting, but we always have seen the pause is the most likely outcome. Today is the first time that it seems like the overwhelming majority of people believe 25 basis points is there, and yet 50 basis point cut would not be crazy. So there's genuinely some open-ended questions about what we might see happen here in just about 9 minutes. Go ahead and vote in that poll right now. What do you think is going to happen? Even people here in our chat think 25 basis points is happening. That is the expectation, but will you be surprised we have 50? That's going to be the question. Of course, after that at 2:30, we are going to be covering Jerome Powell and his press conference live. It's going to be very important to hear what he says about the decision. What does the future look like? Of course, if you have not been paying attention, let me continue to set the stage here, and then I'll introduce my team here in a second. Over the last couple of weeks, we've gotten a lot of data that's brought a lot of chaos, right? PPI numbers, inflation numbers actually came in beating reports. PPI has a way of kind of predicting, telling us a future expectation of what inflation is going to look like. That's very bullish. Of course, inflation numbers last week on the 11th came out slightly hot, as expected, but higher than we've seen them in quite some time. The problem is, it's the unemployment numbers that have actually caused a lot of the chaos. Unemployment is higher than it's been in quite some time, but also the job revisions that happened back earlier this year show that if we had actually had accurate information, we would have known months ago, back in January, that unemployment was a serious concern. And at this moment, we might have had several rate cuts to date. So for that reason, it's very hard to actually imagine what is the Fed going to do. 25 makes sense. 25 is the most likely outcome. 25 basis points is what I'm expecting. But I don't think it's crazy if we see 50. There's a whole lot of volatility left just for today, and then we get to unpack what does the next move mean for crypto. Will we see a massive correction because of the pivot coming? All the bears out there telling us historically these Fed rate cut pivots are historically bearish, or will this finally inject the markets with liquidity needed to skyrocket into altcoin season and all-time highs? That's my longest intro I've ever done, but it's because today's so important. Stick around with us the whole way. Smash the like button if you're excited about the show. Make sure you're subscribed to the channel. I'm going to introduce the rest of my team because I do think we have some people in here watching that have not watched before. I, of course, am Tim Warren. I'm the guy who leads us off, but I got an amazing team right here. I got Smay, who is sitting in the West Virginia stadium as we're speaking. Weird that on Wednesday at September 17th at 1:53, the stadium is packed with fans. But Smay, how are you doing today?
Tim, I'm doing good. You actually missed the memo. This is everybody fill the stands day in Morgantown. Okay. So, and it's also everyone stay as still as you possibly can, which is why there's no movement and or crowd noise behind me. It's really impressive. They do this every year. Anyways, Tim, I'm doing great. I'm doing great. They actually do this every time there's a Fed stream. Okay. It's kind of like they're all gathering to listen for this Fed print data, whatever. Anyways, yeah. I'm doing great. How are you doing?
I'm doing good, man. I got some good news on the other side of this. I want to introduce our other guest here, our other host, but good news coming here in just a second. Some of you have probably even already noticed it, but I also am joined here by Shrum, our head of research, head of blue shirts, head of moving everywhere across the country all the time. I got Shrum over here. How you doing, my friend?
I'm doing great, Tim. I really am. And some might even say I'm better than I deserve. I really do feel that way today. I got my run in, so my adrenaline has just been totally boosted all day, getting stuff done left and right, making phone calls, telling the right people that I love them, and keeping my eyes on these charts. Did make some buys in the last 48 hours. Might get to that a little later in the show.
Yeah, we're going to have to go through a couple of things. We're probably going to do a lot of analysis early. Wait for that 2 o'clock analysis to come out. I was blanking what I'm looking for. We're looking for the number to come out at 2 o'clock. We'll get into some charts, get into some news, get into some thesis on the backside of that. So stick around with us. But some of you will notice that you got taken into an ad during our show. Well, for some of you, you just got annoyed by it. And I get it. Ads are annoying. But some of you will put 2 and 2 together. What that means is that the Tim Warren channel is once again monetized. We have been struggling with YouTube now for months, coming after our show, saying that we're violating different things with promising people results and all this other stuff. Anyway, 3 months ago, our channel got demonetized. It was a hard thing. We actually genuinely were considering starting a brand new channel, going through the whole process, but they have reestablished us as a paid channel here. So if you guys have super chats you want to give, people have been asking that question for a couple months. You can give super chats now. I don't think we're turning memberships back on because we have all that happening over still in our Discord via WAP. Check the link down below if you want to be a part of that. But we're very glad and thankful for all of you guys who have been reaching out to YouTube, telling them to reinstate us, to stop this crazy ban that's happening. And we once again, we are monetized. Thank you to all of you. Let's take a quick look. We're not going to do, again, a lot of analysis here because in just 4 minutes, the most important data point is going to be what is the actual cut. But let's go to my screen here, Smay, and take a look at what crypto things are happening. We're also going to take a look at some stocks. Shrum, we kind of teasing that a second ago. We'll look at the stock market a little bit as well here in just a couple of minutes. But a lot of red with the exception of like a coin like MYX. Oh, look at that. Kenny G just joined a membership. I didn't even know we had the membership still turned on. So I guess we do. That answers right there. Kenny G joined it. Thank you, Kenny, for that. MYX is something I was just texting Crux. Some of you guys know Crux of Crypto. If you're not following his channel, if you're not subscribed, you're making a big mistake. He is a part of our team as well, but he's our fundamental side. We need to do a pretty in-depth analysis on what's happening with MYX. I know it has to do with trading, but it is now, with this 63% boost on the day, number 36, I think is what it's saying. Okay, now it's saying 37, but a second ago, it was the number 36 coin. What is MYX? If you looked at the monthly bubbles, this coin is up 1,100%. Absolutely crazy what's happening right there. So we will do some research on that, get to you. If you guys have been wondering, what is this coin that seems to keep big green bubbles on the regular basis? We're going to let you guys know about that. There are a couple other green ones. We have some favorites over here, like Arrow is up. We love seeing that, but a lot of red still on the day. When you take a look at some of these charts here, like I said, Arrow doing quite well. Let me turn this noise off and let's go to Bitcoin really quickly. Even Bitcoin here having a little bit more of a retracement. Got a blue day here today. Coins like Ethereum have been retracing the last couple of days. Chainlink the same. I told you guys earlier, I'm a little surprised that we didn't get an early run on Monday. And I'll just confess it. Like, I don't want to beat around the bush. I got that call wrong. Last week, I told you that I thought that with the all but certainty we were going to have at least 25 basis points or more, the whales would buy early. I told you the whales would buy probably sometime on Monday. We'd have a rally, maybe Bitcoin at new all-time highs, maybe a couple altcoins hitting that all-time high position. And then there would be a small little sell-off when the FOMC day actually happened. This would be a buy the rumor, sell the news type of an event. That has not been the case. Crypto prices, let's just go even like to total, which is the crypto market cap as a whole, has been stifled here. Total 2, which removes Bitcoin, has absolutely pulled back in the last couple of days. But this is a good thing. This is a very good thing because with the good news that we're probably about to hear here in just 1 minute, again, Shrum, if you see it, let me know.
Yeah,
this means that instead of the whales buying early and selling the news, they wanted the prices to come down so they could buy dips. So when the news came out and there's all this confusion, there's just questions. Listen, you guys even right now are probably saying, Tim, I thought this whole thing was bullish. Why have we been pulling back? Does this mean the bull market's over? That's exactly what whales want you to think. So they get to buy the dip. They get to experience all the pumps during the market. This wasn't a buy the rumor, sell the release. This was a fade the rumor. Confuse the retail by the actual event. I am not going to be surprised whatsoever if we see green candles, white candles, bullish candles happening here in the next little bit. Now, we did just get the results here. Let's take a look at that economic calendar. Let's let it refresh here. Breaking news here, everybody. It's 2 o'clock. Come on, go with me here. They went with, it's all coming down to this, the spinning wheels of
25.
death. Why is it taking so long? Did
It's
you get
on
the
my
results
screen.
out?
Yeah, 25 basis points.
25 cut.
That is it. 4.25 is now the level. This was what was forecast. It was consensus. The previous was 4.5. So we are now, you could make the argument, we have transitioned into quantitative easing. There will be much debate of whether that's true or not, but directionally, it's hard to debate that we have not moved now towards quantitative easing. Congratulations. Welcome. You made it.
There we go. Let's take a quick look at what the charts are looking like on this news. Go back to my screen here, Smay. Bitcoin, you can see, opened at 2 o'clock down here at 115,500. It's back up over 116. So Bitcoin reacting kind of bullish here. It's volatile, but it's acting bullish. Ethereum with a big white candle here. Again, you're going to see this is the 1 hour candle, but because we are sitting at 2:01 on the dot, this is all what's happened in the last minute and a half. It's volatile. Some people buying, some people selling, but it is looking like early reactions are that this is bullish. Even though this was the massive prediction we had. Fed Watch Tool was telling us, you can't see it behind my face, but 93% chance of 25 basis points. Polymarket, now it says 100%. A couple of minutes ago, it did say 90, I think it was saying 93% probability of a 25 basis point cut. So it's expected, but because the prices were dwindling going into the cut, it does look like we are rebounding quite nicely. And that's kind of backing up what I was just saying here not that long ago, right before we got the numbers. This absolutely has looked like it was a fade the rumor by the release type of event. Let's see how some other coins are looking like. XRP with a nice big move here in the last couple of minutes. And when I say a nice big move, look at these other hourly candles we've had recently. This, if we continue this for the next hour, is one of the largest candle movements we've had over the last couple of days. Solana responding very nicely back up here at 237. Chainlink back up over $23 after spending some time down here closer to 22. It's a very, very good sign for the crypto markets. What's going to be very important, here's where we kind of get into some more details here. What's going to be very important to see is what happens in about half an hour from now. What happens when Jerome Powell takes the stage? Does he give us the feeling that this is the first of many, or this was a one-time, let's see how the data points respond in the future before we decide anything more? But just so you're aware of this, the next meeting will be a month and some change from now in October. Already, that prediction is saying 72% probability that we will get another 25 basis point cut in October. But what does Jerome Powell say about that? Does he echo that? That, to me, would probably imply that these markets are ready to start making moves to the upside once again. If I can grab the marker here, those moves will be making moves to the upside. If he kind of makes it seem like, yeah, we decided to cut rates, but we're not really certain what the future looks like, that is the scenario in which we fade to the downside. And this is a situation right now. I know I'm kind of all over the place. Stick with me. We're kind of breaking this all down as it's coming out here. I was doing some live trading earlier today with the Tim Warren Trading Group. Yes, that's the exclusive group we have. You can go purchase access to that group down in WAP in the link down below. I'm at a war within my brain about what I think is going to happen. I've laid out to you, I think that the news and the fundamentals of what's happening is very bullish. The problem is I can't ignore the fact that the charts aren't necessarily saying the exact same thing. I want to start off by actually taking a look here at Ethereum, right? So Ethereum back up over 4,500, but you can see pretty clearly here in the Lux Algo Oscillator on the daily chart, we don't have a red reversal, but we absolutely have negative money flow and a gray dot. You're going to see this across the majority of coins out there. XRP actually is not one of those. XRP has a nice looking chart. Solana, negative money flow, bearish divergence. This one has a red reversal and it has that gray dot. Chainlink, negative money flow and a gray dot. Ondo, negative money flow and a gray dot. The charts here on the daily chart are not necessarily sitting the way we want them to sit. Even when you drop down, let's say back towards a 4-hour chart, the money flow's low, but it hasn't corrected just yet. What does this mean? It means if I'm not trading the news, if I'm not trading in anticipation that I think that whales are about to buy, the charts are suggesting we might not be done to the downside. Yet the news and the way this reflects makes me think that this whole move has been a manipulation. Starting back last weekend, we started dipping on Saturday. Everybody and their mother knew that a rate cut would be bullish for markets, and yet prices have pulled back. I just have this sneaky suspicion that despite the fact that charts are suggesting this dip might not be over, the charts are suggesting, hey, we really could probably make a move. Let's go to the daily chart again. We really probably could make a move on Ethereum back down to 4,300. We probably really could make a move on a coin like Chainlink all the way back down, at least back to 21, if not all the way back to $19. Like, these are things that you're looking at and saying, I got negative money flow and a major order block down here. I have to be aware of that potential. And yet I have this sneaky gut feeling that we've had several times before. The manipulation trap is in play. And I got this sneaky feeling we're about to see something rally to the upside. Another reason why I'm kind of bullish here, and I know I've been dancing all over the place with the charts. We'll take a look at some more specific charts later on, keep you guys up to date with things. But I was telling the VIP trading group as well, there is a positive to how these things are moving, because when I look at the oscillator, just a couple of short days ago, we actually had a buy signal, green reversal, bullish momentum, positive money flow. And I got flipped this weekend and turned everything south. Well, in the same breath, if this weekend, despite the fact there was no big news that came out, if we flipped bearish on no news, more than likely because of whale manipulation, is it not very easy then for whales to flip this script back, get the money flow coming back in, get a green dot in play, and all of a sudden we're bullish once again with targets back up to new all-time highs and coins like Ethereum charting $6,200. You got to continue to wait and let this play out. The chart purists out there, the people who rely upon charts, the people who say things like, forget about the news, only follow the charts. The charts tell you what the news is saying. They're going to tell you dip not over. Time to keep going to the downside. People who look at just nothing but the news are going to tell you it's nothing but bullish. I'm torn between the two because the charts are not telling me it's screaming to the upside time just yet. But my heart, my gut, and the news is telling me we're probably ready for a big move to the upside. The question is, what does Jerome Powell say here in literally about 20 minutes? Shrum, I want to throw it over to you for a second. Get your take on it overall. How are you feeling about this? Is this what you were expecting? What are your thoughts about how the markets are reacting to this news? Again, very volatile, up and down. They really haven't decided yet. Do they want to be too bullish or too bearish? What are your thoughts right now?
Yeah, well, I mean, my thoughts is that this is good, right? We've been talking about the zone of uncertainty that we've been trading through. We talk about this in the morning news crew over in the Discord, and now we are out of that zone of uncertainty, right? Now, that doesn't mean that the volatility is over, and that doesn't mean that the market has fully priced in what this cut means. There's still more energy to be expressed into these markets. However, this is the outcome we've been waiting for. Was there money on the sidelines waiting for the 100% certainty that we would get a cut? Absolutely, right? That money does not deploy until there's 100% certainty. Now we have that. We can expect the rest of this week to kind of express that thesis, right? For that money to come off the sidelines. And it's not going to go straight into Bitcoin. It's not going to go straight into Tesla, right? But it will start to now plan for what's to come in 2026, right? There's a higher level of certainty than we had 5 minutes ago of what 2026 is going to look like. And, that's just the rate cut that we just got, right? There's also, if you go to my screen, there's also this dot plot that, Tim, you are so fast in tweeting this out. You're just a whiz over there on Twitter. It says this: dot plot revised lower from June. June was the last time we got a CEP, Summary of Economic Projections. The median projection now shows 50 basis points more rate cuts in 2025. So you can see here, you have this outlier down here. That is presumably Stephen Mirren, who's the latest board governor. He's just kind of causing mayhem here. But as you can see, it's a little bit may be difficult to see with how zoomed out we are here. But this cluster of dots right here is the median rate, and that is just over 3.5. Whereas the previous clustering of rates, dots right here, was above, just below 4. Okay, so you have a movement to the downside of what the average governor thinks that the rates will close at the end of 2025. And you can also see, similarly, you can see movements to the downside in 2026 and 2027 projections. And for the first time, we have a 2028 projection as well. That's what this clustering of dots is here. I would say that this doesn't necessarily tell the most optimistic story, but what it does say, considering there's still dots up here at 4, just under 4, but what it does show is that there's a clustering of dots right here. And I mean, you guys might be tuning in the first time. Who's this guy with his dots? What the heck is going on here? This is kind of a graphical illustration of the consensus of where federal funds rate will be in forward years. This one is 2028. It's a first look that the public, that the economy has had on where the FOMC thinks that rates could be, and that is below 3.5, actually 3.25 it looks like. So that's pretty bullish.
Say that number again. The dot plots now are projecting where will we be at the end of December?
So for December, we could have 2 more 25 basis points cuts, right? So a total of 50 more basis point cuts going into 2026. Makes
sense. Okay. Very, very good. Yeah, I think at this point, that's what is looking more than likely what we have going on. That's good news, because that means Jerome Powell is more than likely going to come out and say, we think it's appropriate to officially begin a pivot. And that's something that's very different. He didn't really announce a pivot last year in 2024 when he cut by 50 basis points. He announced that the job market was concerning, so they wanted to cut rates quickly. Inflation was a good level. The economy was a good level, but they wanted to respond to job markets. This time, it sounds like an official pivot in their strategy is coming. He hinted at that at Jackson Hole. So that's going to have a completely different situation going forward. Let's do one more thing. I want to cover some other stories here in just a couple of minutes, but I'm tracking here while Shrum is speaking. Let's take a look at the charts, and let's take a look at how money flow on the 1 hour is starting to come in on some of these coins. Let's start off here with Bitcoin. This is going to be very important to watch. Money flow at the moment on the 1 hour chart is still negative. It's rounding. We do have a green reversal dot and a green momentum dot in play. But the money flow is the most important part of this indicator, not quite bullish. That will be interesting to watch as the rest of the show goes on. I'll keep you guys tagged on it, and I'll be chatting. Even if Jerome Powell is speaking, I will comment in chat important updates to money flow, because I do think that's very important here. Let's take a look at Ethereum's money flow. You can see it wasn't really aggressively down. It's not positive just yet, but it's been very boring here for quite some time. Other coins here, XRP still negative. Solana is positive right now. Solana has actually creeped into the positives. Chainlink, after being actually pretty negative this morning, Chainlink has turned positive. You officially have a 1 hour buy signal here on Chainlink with green reversals. We have bullish divergence, a green momentum dot, and positive money flow already. In short, what does that mean? It means I will have a short-term target on Link back up here towards 2332. So keep an eye on that throughout the rest of the show here today. Can we get that 1 hour to turn into a 4 hour, turn into a daily? That's what we're kind of looking for, the switches there. Let's look at a couple other big coins people are very interested in. Ondo's money flow looks like it has turned positive. In fact, actually, Ondo turned positive yesterday afternoon and has not been negative really that much at all. It's back above $1 here. Cardano, let's see how Cardano's performing. Boring, nothing's for certain. Slightly negative, but nothing for certain there. Last two, Sui and AVAX. How are they performing? Sui still has negative money flow, and AVAX has negative money flow. We will be watching that throughout the rest of the show. Can we get a turn back to the upside? It does look like we're catching a little bit of a sell bid here as Bitcoin is back down to 115,500. So the volatility continues. The volume has increased. It's coming in here pretty nicely as people are deciding what do they want to do with this information. I would tell you guys right now, don't overreact in either direction. Don't think that just because you start to see some sort of movement happen in one way or the other, you know exactly what's happening. Volatility more than likely will continue aggressively throughout the rest of this show, throughout Jerome Powell's speech. And the reality is it'll continue even into tonight's hours. We really won't have a firm grasp on the direction the charts want to go until tomorrow. It usually takes almost 24 hours for the markets really to sort out the volatility. Early signs was excitement. Now they're falling back down. But as I told you, we already kind of knew that the money flow hadn't quite turned for us. We are going to need to see money flow curve back to the upside. We're going to need to see more money coming in than going out to feel like a bottom is in place. And I do think that 1 hour chart is going to be very interesting to keep an eye on. Let's cover a couple stories here that are also impacting the markets along with FOMC today. There was some big news for NVIDIA. This is on the stock market front, but a lot of you know that the crypto markets have a relationship with NVIDIA. It does seem like when NVIDIA's charts have problems, crypto can have some temporary problems as well. Breaking news, China's regulators are ordering tech firms to stop buying NVIDIA AI chips and cancel the existing orders. This absolutely could bring a dip for NVIDIA, which could cause more confusion for crypto. For more on that, though, our stock expert, Shrum, what are your thoughts here about the NVIDIA story?
Yeah, well, I told the Discord I sold all my NVIDIA that I've been holding for years last week. Okay, so I'm out of NVIDIA. That doesn't mean that I think NVIDIA is going to zero, but I would rather buy it at some lower levels than where it is now. I think NVIDIA could easily get down as low, and I told everybody this morning, maybe like 150. That's like a not very crazy level to get. In fact, that would only be from the live price, like right around 11% shed. Okay. But the problem with this headline that you just read, you can back full screen, is that China buys a lot of chips and now they're not really allowed to buy those chips from NVIDIA anymore. So you have to ask yourself as an NVIDIA holder, is that a recipe for success for the future of NVIDIA in the short to midterm? Now, obviously, a company like NVIDIA is not going anywhere because they're extremely critical to the chip supply in North America and all across the world, especially advanced chips. They just came out with a new chip for humanoid robots. That has a lot of promise, but it hasn't delivered yet, right? It's just promise. Whereas a lot of the margins for NVIDIA are continuing to shrink, right? The rate at which NVIDIA is making more money is actually decelerating. Now, are they still making a lot of money? They absolutely are, right? But a lot of that you could argue is priced into the stock share right now. And so it's going to come back down and test support. And if it get down to 150, I'll be buying it. And if it gets down to 120, I'll be buying even more of it, right? So love NVIDIA, but I do think it's got more headwinds than tailwinds right now. And these Chinese headlines about China not being able to buy more NVIDIA chips is definitely not helping. So that's where I'm at with it.
I would also say let's not close the book on this story whatsoever. We all know that China and the United States have kind of a little bit of a, what's the right expression I want to look for here? They keep puffing their chest up at each other. I mean, in recent days, President Trump has even asked NATO countries to inflict an 100% tariff on China to put pressure on Russia to end the war with Ukraine. China and America are going back and forth at each other. They know certain moves they make hurt the other country, only for a week later them to back off on those deals. It's all a part of ongoing negotiations. With NVIDIA being an American company, with Trump trying to get them here, putting everything in here, China absolutely knows if we stop buying these, it's going to put pressure on a massive American company, which puts pressure on Donald Trump and his administration. This is a part of an ongoing negotiation. Don't be surprised if China flip-flops on this in the near future. For right now, this is not good news. For right now, like Shrum said, you can absolutely see a dip coming to NVIDIA's market. But another one, I think it's way too soon, and I think we've learned, even if you've only been paying attention to news and markets this year alone, we've learned that China has a way of flip-flopping on things like this. Don't decide right now what the final story looks like. Let's move into some positive news, though. Some more coming in here. Just in CME Group to launch options on Solana and XRP futures. Is this a return of volatility on XRP and Solana? Shrum, what does this mean for everybody out there? What does it mean to have CME Group launching options on these two tokens?
Yeah, well, if you think about it in the macro, ETFs reduce volatility because it compresses investment and centralizes investment, and options do the opposite. Options increase volatility because there's more jitters up and down on the underlying asset. So there's been the release of ETFs for Solana and XRP. Now, XRP, I believe, is the only one that has a spot ETF in addition to Ethereum and Bitcoin, but Solana's not too far behind with some futures ETFs. So now it's time to reintroduce volatility, or at least so says the CME. Could this be a big tailwind for altcoin season? After all, we do need volatility in order for these prices to go melt everybody's faces. I think this is exactly what that means. Options market for two of the biggest blue chip altcoins. I'm here for it. It's going to take us higher.
Very, very good. More news coming in here. If you're a Cardano holder, you're going to love this one. Charles Hoskinson will be attending the U.S. Senate Market Structure Legislation Roundtable Is this bullish for Cardano? Well, I'll tell you, it's not bearish for Cardano. Shrum, what are your thoughts on old Chuck getting to make the meeting here with the government? What are your thoughts about Cardano here?
Yeah, I mean, it kind of depends how it goes, right? Charles Hoskinson has conducted himself publicly in ways that haven't resonated with investors historically, but other times, he's been an absolutely smash hit. So we'll have to see which Hoskinson we get at this particular event. But you can rest assured that this will be the first time that a lot of people with deep wallets hear about Cardano, hear about Charles's products and his vision for crypto in the future. That could be good for Cardano and for ADA holders. But again, we could get that Jekyll and Hyde effect, and we could get an angry, unlikable Hoskinson there in the hot seat. We'll just have to wait and see.
Yeah, I think it's got a side of being on the low end a nothing burger, on the high end positive. Unless he answers a question horribly and puts a black eye on the crypto community, I don't see a way in which this makes Cardano look bad. I think it would only work to be positive for the ecosystem. Let's end the last story, though, on a 100% guaranteed bullish story. There's no way to twist this, although the bears will try. There's no way to twist this and say there's a bad outcome here. Big announcement from Metaplanet that they are going to be investing, go to my screen here, $1.25 billion with a B, dollars, dollar symbol with a D, into Bitcoin by October. Guys, we're not that far away from October. $1.25 billion of buying. That will be absolutely huge. Big Bitcoin buyers at the table to wrap up Q3. Don't have to remind you guys, even if you didn't take economics in college, when people buy, prices go up. When the demand outweighs the supply, you get an increase in price. No way to spin it. That's not negative. That is absolutely positive. More demand coming in for Bitcoin, and it will trickle to other altcoins as well. So that is some fantastic news. In the last couple of days, as we've been chasing this chaos and deciding what's going to happen, we've had a lot of people come out in both directions. I'm still going to side with someone like Tom Lee. We've talked about him for the last couple of weeks. Tom Lee, of course, a very big proponent of Ethereum. He's kind of becoming slowly but surely the Michael Saylor to Ethereum, but he still likes Bitcoin as well. He's made comments in the last couple of days that he believes today will be a massive boom for both Bitcoin and Ethereum. And while he doesn't dabble too much in the other altcoins, he kind of keeps to the world of Bitcoin and Ethereum. You don't really see a world in which Bitcoin and Ethereum rip to the upside and yet altcoins get left behind. What do you think about this, Shrum? Are you a believer that Tom Lee is a good predictor of futures, or have you found him to be unreliable in his analysis?
Well, if he was unreliable in his analysis, he wouldn't be invited every 5 minutes to a talk on CNBC, right? He's way more right than he is wrong. If you've spent 15 minutes in the markets, you know that you're going to be wrong if you're going to take bets in liquid risk assets, right? That's what happens. But I think Tom Lee is kind of the GOAT for now, right? I mean, there's Michael Saylor that's on top, but these are the new Warren Buffetts. They understand that fiat printing is not going to stop. And just like Warren Buffett figured out, you can buy companies that are undervalued and then sell them when they're overvalued. I think the thesis for our generation is the central banks are not going to stop printing money. So buy gold, buy Bitcoin, and that does trickle down to buy Ethereum too. So I don't think it's rocket science, and I think Tom Lee is going to continue to look like a genius on CNBC.
Yeah, I think so as well. Now, I will say my only devil's advocate argument against you is not everyone who gets invited on CNBC is a great predictor of things. I do think Jim Cramer has made several appearances there as well. With that said, though, that's the devil's advocate argument. I myself think Tom Lee, it's funny, Tom Lee, people are going to say, I've heard him accused of being a perma-bull. What's funny is he only talks being perma-bull when it's time to be bullish. Whenever it's time to be bearish, he just seems to evaporate, and you don't hear about him ever. He only wants to talk when it's time to be buying. He's talking right now. He's talking about major things happening. I tend to believe Tom Lee is going to be accurate here. Guys, if you're just joining us, thank you so much for being here. This is live FOMC meeting. In 6 minutes, Jerome Powell will be live. We will cover it. We will monitor charts. I will keep you guys updated on what is happening. Let's go back and look at some charts here. We'll do some paint drawing watching. That's what happens when you're looking at charts like this. Bitcoin here, very volatile in the first 20 some odd minutes of the announcements that we just got 25 basis point cuts, the first Fed cuts of the year. We started by skyrocketing. Let's not say skyrocketing. Let me rephrase. We started by rallying. Let's not get out of control. We only went up to 116,300. Then over the next couple of minutes, we'd fall all the way back down below $115,000. Now we're back up, pushing back towards 116,000. I told you, be careful. It's going to be volatile. You can see we made a nice correction all the way down into an order block, back down to buy levels that we had here yesterday around 9 a.m. before making a bounce back to the upside. Another chart I want to take a look at here that I'm seeing is very interesting. I was telling our VIP traders this earlier today. Don't sleep on this chart right here, because this could have massive potential at telling us what the future looks like. What chart do I want to look at? Let's look at the daily chart here. Let's go to the 4 hour. 4 hours is going to be better here. Some of you know that we've been tracking the Bitcoin dominance chart. It's been trending downward now ever since its highs back here in June of 2025 when it was over 66% Bitcoin dominance. Why is this chart important? Some of you might be saying, Tim, why are we looking at a Bitcoin dominance chart? Because Bitcoin dominance falling does not correspond with bear markets. Bitcoin dominance falling does not correspond with massive corrections. Bitcoin dominance falling corresponds with an altcoin season and a massive bull run. And after dropping to recent lows here last week down to 57.26, we did make a nice rally back up. People are saying, oh, here we go. Bitcoin dominance is rallying again. Watch where Bitcoin dominance for the last couple of days after that rally came back to and struggled before today. We're having a nice little correction once again. You'll see a nice little red line drawn right there. That is the support level. It really should be a green line. Let me change this color real quickly. This was the rising support level of some contractions we had here just a couple of weeks ago back in August of a bear flag pattern. And if you know anything about technical analysis, whether you're in the VIP trading group and you've taken the academy classes where we teach formations, or you've just been around the block and heard other technical analysts talk about it, it is not uncommon at all to break out of patterns like this, retrace to touch former support as resistance, and then continue on your merry way to the downside. I'm not promising you that Bitcoin dominance can't make a valiant, move to the upside and start rallying again. I would say if we start to see a massive rally, I would say, I don't want to say this with crazy confidence, but I would be concerned about the bull run if we see Bitcoin dominance get back above 60%. I wouldn't guarantee it's over. I'm just saying that is a concerning break of bearish structure here on this chart and would make me believe potentially the markets are in trouble. But we haven't done that. We've done a very classic bullish move here by rejecting on former support level. And if this continues and we keep slipping back below 58%, that's going to be a very positive sign that the markets are reacting the way we thought and everything is going quite well here. Let's take a look at a couple other coins. Again, let's check in on the 1 hour charts. Ethereum with its own volatility coming in. Let's turn on some indicators here. Take a look at what is happening. ETH is back up, rivaling 5,500 after dropping down, touching that order block that we did have here even earlier. We've hit this bouncing point here on 44.38 several times over the last 2 days. We touched that support level once again. A lot of volume coming in right now, more volume than we've seen in quite some time. ETH looking pretty good here on the short run. XRP coming in here, falling back down to an order block and a 1 hour smart trail. Now it's making a nice boost again. We do need to get above this wick right here. You guys can see this red box here over last hour's candle. That is a liquidity box. That means that this candle was taking out a lot of take profits on long positions and hitting some sell signals very heavily. There were a lot of people with sell signals. So getting above this block, getting above roughly $3.07 will be very vital for XRP to ignite the next leg of the bull run, because at the moment, this red box on this candle did signal that was some high liquidity grabs that got taken out and can be a sign of a top coming in. It's not a promise. It's not always. You can see it also happened back here Tuesday the 16th and Tuesday the 16th as well here at around 12 o'clock on the 1 hour chart. But you can keep going up. But a lot of times with something that big, that means a lot of people either took profit or entered into short positions. So let's cancel those out. Let's get a short squeeze in play and make that move up. A couple of the coins, let's take a look. I always love to take a look at Chainlink, keep my eyes on what Chainlink is doing. Like I told you, there's a bullish divergence here on the 1 hour chart. We are coming back up to that level I told you would be important. Now it's time to start watching the 4 hour chart on Link. Can we get that money flow going positive? Can we get a buy signal in play? And all of a sudden, we're talking about a move back up towards $24.30. I'm going to stop talking, though, because it is 2:29. We are probably seconds away from Jerome Powell taking the stage. Drop in chat how you are feeling right now, though. You can go off my screen, Smay. Are you bullish? Are you bearish? Is the bull market still ahead of us? Or are you concerned? Is it time to take profits and run for the hills? Smay, do we have Jerome Powell on the stage just yet? It is 2:30.
He's not on the stage.
Not yet. So this is the part of a live television where we just have to kind of talk and make sure there's no dead air. The worst thing in the worst thing in the world is dead air. There's the stage. No Jerome Powell. Shrum, give me your takes. Last thing it takes before we got it. He's walking out. Last take. Bullish, bearish,
here he comes.
Sell, buy.
Oh, he's going to be dovish. He's going to be dovish.
Here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
You can't.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply. And to the point where we see what I've called a curious balance. It's, typically when we say things are in balance, that sounds good. But in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timmerosa, the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when we feel that policy is a place and needs to move quickly to a place. That's not at all.
Uh-oh. Hey, you're muted, Shrum. Maybe we good?
Yeah, let me see if it's lagging on my end too. I think it might just be their stream.
Yeah.
With 8 and
Weird. Oh, that was a good question. Would really like to hear the answer to that. Whatever you said isn't good though, because the prices are dropping. B-Ball Golf says it's not the video drone is buffering in real life. It's possible.
Yes, mate. Go ahead and refresh on your end because I am getting a live feed.
Very strange.
3 months ago with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut because if you look at the SEP.
Goodness.
Uh-oh.
You getting a live feed, Shrum?
Kinda. Yeah, maybe try to pull it
towards more cuts than just 3 months ago with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut because if you look at the SEP.
Yes, it's not buffering past that. It's just going back to the same thing.
I'm going to try pulling it up on YouTube.
Goodness
I think
gracious.
they're having issues on their end.
Yeah, we apologize, everybody. So far, while May, you're getting that set up there. So far, it's been a very interesting conversation so far. There is some positivity coming from him, and at the same time, concerns coming from him. Since far,
April, to me, the risks of higher and more persistent inflation have probably become a little less, and that's partly because the labor market has softened, GDP growth has slowed, so I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
If I could follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, and this is quite an unusual situation, how do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and they're making their arguments, and we're having really a great discussion around these challenging issues. So,
Do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that, and it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
He should be a yoga instructor.
Thanks. Howard Schneider with Reuters. So, as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter, and I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that. You see minority unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment. and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So, that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve system and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to always trying to do better.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, I mean, analysts have different views, but we think it's contributing, 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
You got to swing for it, though, man.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of, the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really. The only way for any voter to really move things around is to be incredibly persuasive, and the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters, and that's how it's going to work. And I think that is the way the institution. That's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there's a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you. Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly. And that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point. And that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
I'll follow up if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected, what we got earlier this week, I guess. And also we're getting, a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply. And so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up. During the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times, and as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow follow-up. This rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
Not his problem.
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated right now.
You guys are funny in the comments.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
This is running long.
As you said, shorter term inflation expectations have tended to respond to near term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer term inflation expectations, both break even in the markets and almost all of the longer term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But we're, as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates. Thanks very much.
All right. Yeah, I feel like it's usually over by like 3:15. That seemed to go very long. It's time to jump into it. What are the takeaways here? I'm a little conflicted in my thoughts. I'll be honest with you. It was a little different than I thought, but I took some notes. You guys, if you saw me looking away, I was taking notes, thinking through things. I'm going to save my thought for a second. I want to throw it to you first, Shrum. What big notes you thought, even whether you wrote notes down or whether you just kind of internalized them, biggest points of takeaway for you, and just how are you interpreting this meeting overall right now?
Non-committal, and I think there's a lot of things that kind of signal that they're going to take this on a case-by-case basis, even into the end of the year. But I'm here to tell you that when the Fed cuts or hikes, that is usually followed by a repeat of that policy change for quite some time. Now, the last policy adjustment, though, was a break of that trend where they cut 50 basis points right around this time last year, and then they did two more cuts, and then they stopped, right? So are we going to get more of that, right? I think that Jerome Powell is in a little bit of a difficult situation because, again, as the academic would approach this, the classical way to operate the Federal Reserve is to go ahead and focus on unemployment and inflation. And right now, both of those are kind of moving in directions that are unfavorable, where unemployment is actually moving higher, inflation moving moving higher as well. So both of those things kind of simmering, not out of control, but potentially posing a risk. It's like, well, what do you do in that case? It's difficult. So he's in a tough spot, from an academic standpoint, but there's just no way around the fact that the United States has a almost $38 trillion debt. And the higher the interest rate goes, the higher the interest payments are. So it's not rocket science. There's only so much that they have upside that they can actually go with these rates in that kind of a scenario. So hiking rates are essentially off the table, right? Which is a little bit scary in some sense. That one of the main weapons that's available to fight off, enemies of a thriving economy is just unusable because of how much the federal debt is. But with that said, for folks like us who want to see asset prices go higher, that's kind of a good thing, right? Because, okay, they're not going to hike. So what are they going to do? They're going to either pause or cut. And when they're not pausing, that means they're going to cut. And so we're just kind of sitting here, like I said earlier to start the stream, kind of sitting here just milking this thesis that central banks, not just in the United States, but all over the world, are just going to keep printing money. They're going to keep cutting rates. And that is just going to make gold more valuable, Bitcoin more valuable, and probably Microsoft and the rest of the S&P more valuable over time, including real estate. So, it's a tough time to be someone who hasn't started to save money, though. And that's young people, and that's people who are in poverty.
Yeah, I think we're going to start off by saying, first of all, go to my screen, Smay. Markets are, I wish it wasn't doing this because this is what I was going to say. I'm not going to be surprised if markets start pumping here soon. Sure enough, we're back up above 116,000. We'll go back and take a look at that in a second. As I'm reading chat, I'm listening to people. Chat was interpreting a lot of stuff happening as being hawkish, negative, bad. I don't agree. Was his mood pretty dumb? Yes. Were there a lot of things that I was just like, why are we even talking about this right now? Absolutely. I'll tell you what my takeaway from the whole meeting is, and then I'll tell you my notes. My takeaway is not going to surprise a lot of you. It's time to end the Fed. My takeaway is it's time to end the Fed. I don't even know how you do that, right? I don't know who needs to go vote on this. I don't know who gets to decide. I'm pretty sure the president can't just say we're firing everybody and ending the Fed. But whatever needs to happen to get that done, let's get that ball rolling, please. Let's end the Federal Reserve because that was a dumb meeting. Let's talk about the notes that I have here. Again, people acting negative, but let me really break down what was said, because you can say, oh, well, this question, that question. He didn't answer questions, ladies and gentlemen. He did not answer questions. He did the political thing of saying certain questions, I'm not going to respond to that. And otherwise, there were several questions I remember him answering a different question. It's that classic tactic. They actually taught you that in debate when I was in high school. If someone asks you a question you don't want to answer, speak a lot and then round the conversation to answer the question you actually want to answer. Jerome Powell probably did speech and debate in high school because he used that tactic a lot. But let's cover the notes of what he did say. GDP expectations will be better. At this point, are expected to be better than thought earlier. What does that mean? If the GDP expectations are higher, that means the economy is doing quite well. So they're not concerned about a bad economy. Unemployment rising, but not out of control. So he talks about inflation a lot here, but he notes unemployment's rising. It's higher than it's been in its zone recently, but it's not out of control. If it was out of control, then there would be a massive recession fear, but it's not. On the thought of inflation, inflation is not at the 2% target that we want, but it's still in line with our longer term goals. Now, more about those goals here in a little bit. It's one of the biggest reasons why I'm sitting here saying my takeaway is let's freaking end the Fed. But I want to be very clear here. The overall thought process is unemployment is rising, but it's not out of control. Inflation is a little higher, and it's not at our 2% target, but it's still in line with long-term goals. Overall, what's the big takeaway? Inflation risk is up, but so is unemployment. And because unemployment is the bigger concern at the moment, even though he didn't want to say those words, it's what you do when there's a cut. If inflation was the bigger concern, you keep rates paused and you potentially talk about hiking rates. By cutting rates, him along with the rest of the Fed solidified unemployment is the bigger concern than inflation. But what got me laughing and chuckling a little bit, you probably even saw it during the show. I can't remember the guy's name who asked the question, but he pretty much asked, he pretty much said, hey, I've noticed that 2% target you keep giving for inflation is always 2 years away. It was 2 years away 2 years ago. It was 2 years away last year, and it's again 2 years away again. And the way Jerome Powell answered that question was the dumbest answer I think I have ever heard, to where I'm going to save you the trouble of what he actually said and get to the crux of it. He said, yeah, we don't know what we're doing. Yeah, we just throw that out there just because. They have no way, like this concept of, oh, well, we put out these dot plots of how we think no, let's just admit it, Jerome. You and the 11 other members in that room who are voting have no idea what you are doing. You have no idea what to expect. You don't know how to read data. The people that are getting you the data don't know how to record the data to get it to you. The whole thing is one big bad word. I'm not allowed to say that word for my own moral reasons, but also because I don't think you guys want to hear those words right now. The whole thing is very dumb. The Fed has no purpose, no point other than being frustrating and stupid, and I think all of us felt that way. The other thing I want to talk about that's just so stupid is he talks about how you have both a rising risk of inflation and unemployment, so we have to do our best to juggle it. I understand that's the nature of what you're doing, but I just want to make it very clear here, Jerome Powell. If two people are drowning and they're in opposite directions and you can only save one, you will drown yourself trying to save both people, and you're going to be a failure. You have to choose one person to save. You're not going to be able to simultaneously save the unemployment rate and save the inflation rate. You got to choose one, Jerome. But this concept of, well, let's just kind of see it case by case and we'll see, you're going to end up losing both of them. And what's so funny is it's a little bit of a contradiction, because some other things he talked about was that even when it comes to tariff fears, people love to bring up tariffs. And I'm not sitting here, by the way, what I'm about to say is not saying I love tariffs. Let's keep the tariffs going. That's not my point. I'm using the words he used, and I'm going to rip it apart what he's saying. The tariff fears that have kept them from cutting rates, he even admits would be a one-time price increase. What does he mean? The tariffs come in. We have to raise prices of everything. It causes inflation to go up, but now all of a sudden we got used to that new price and inflation would stop. Unemployment, on the other hand, can keep going up and down at its own pace. What is he ultimately actually saying, but he's not acting like he's saying? He's saying, hey, tariffs actually aren't that big of a problem, or not as big of a problem as some people think. And yet his hesitancy to tackle unemployment head on, that is the big problem. I'm bullish, by the way, guys. I think the markets are going to go to the upside, but let me tell you a scenario in which this whole thing ends up going downhill and the markets crash. It will be tiptoeing around tackling unemployment for the sake of trying to save inflation, because at the end of the day, every single time that we see a massive, massive, massive crash due to recessions, it's because the unemployment rate was fine. It starts to tick up and people don't take it seriously. They respond to data as it comes. And then in one short month, we see a massive jump in it. Jerome Powell, you should know this. You have studied the history of the Fed. You never see unemployment rise like this. Never once. And let me go look at that chart real quick. Let me show you the volatility of which you see unemployment. Give me just a second here, Smay, and I'll get it pulled up here. I gotta go to the monthly chart. Give me just a second here. If it'll load, I don't know why my chart's not loading here. All right. Go ahead. Go to my screen here. Look at the jumps. This is the unemployment rate. Look at the jumps in unemployment. Do we ever see a trajectory of unemployment and a slow burn? Not one time. We see lots of slow pullbacks. But if you look at the unemployment rate, January, March 2020, of course, that was COVID, but very fast. May of 2007, very fast. 2000, very fast. You don't just slowly see this slow burn. No, everything is under control, and the next minute you blink and unemployment's out of control. But the way he's acting as if the history suggests that you'll see the upward trend in unemployment and be able to catch it before it's too late, that's not how it works, Jerome. And while, again, I am bullish, you can go off my screen here, Smay. While I am bullish, my only concern is that if the Fed does not get consistent here and start actually tackling the unemployment issues, you're going to see a repeat of that history. And then you can say, all the bears out there who want to say, guys, don't you know that rate cuts are correlated with crashes in the markets? No, we tackled that last time. They're not correlated. There's lots of times we cut rates and markets go up. They're correlated when unemployment is not dealt with and unemployment skyrockets. So what's my case here? Jerome Powell and the Fed, do your job, tackle the actual monster in the room, unemployment, and everything will be okay. I don't think they can do the job. I think they should be ended. Here's the deal, though. Why am I still bullish? He still wouldn't say these words. He was asked at the very end, are you going to cut rates multiple times? He refuses to answer that question. Don't worry about it, guys. Jerome Powell does not make these decisions by himself. There is a room full of people that vote as well. Those dot plots tell you the story. And those dot plots tell you we will get rate cuts in October and we will get rate cuts in November, barring unemployment miraculously falls off a cliff. And by I mean that, it's a good thing. All of a sudden, everybody has a job. If everybody gets a job next month, then we don't need to cut more rates and everything is okay. But that's not going to happen. 25 basis points is not going to save millions of jobs across America. They will keep cutting rates. And if for some crazy reason they don't, God help us, because that's what will cause the recession. That's what will cause us to crash. And I urge again, I don't know who's watching this show, who has the power control to do so, but can we get that ball rolling to end the Fed? Pretty please. That would make me a lot happier. I think a lot of you a lot happier as well. That's my breakdown of what we just saw here. Let's go take a look at some charts. Let's see what's going on here. Nothing on the macro perspective really changed. One thing kind of did, but Bitcoin's here, still below 116. We are flirting right now. Very good white bullish candle here. The money flow, like I told you, is one thing we're watching. It's not quite positive. We do have that green. I was kind of highlighting that during it. That's a big deal. The green momentum dot is coming in. That money flow is absolutely looking like it's curving right now. In fact, minute chart, let me get rid of that line. We've actually been flowing pretty positively since this morning, and that's staying positive, right? If this was curving right here, grab that mark again. If this was curving over, I'd be concerned, but that still has a lot of room to the upside there on the 10-minute, 15-minute. You're looking good. Even let's cut that 1 hour and a half and go look at the 30-minute. We got a massive bubble that's in the process right now of popping. Do not be surprised if we're about to see a surge on Bitcoin. Guess what makes that actually really good for the rest of the coins? I don't have time to cover every single coin here, so work with me. Do your own analysis. Make sure in trading. If you want to learn your charts, go check out the VIP trading group. I'm teaching people. There's an academy where I teach you how to read the charts every single day. We have live trading sessions, but look at this one right here. Bitcoin dominance is falling, ladies and gentlemen. We started that meeting over here, back up around 58.20%. We are about to fall back below 58. Why is that important? Because if Bitcoin's chart is showing us we're pumping here a little bit, if Bitcoin looks like it's ready to make a nice little move to the upside, and yet the Bitcoin dominance is falling, that means the altcoins just want to make their moves maybe a little bit faster. Coins like Ethereum and XRP with these nice, strong hourly candles. There's Solana right there. Chainlink is looking good here. Altcoins are making some moves right now. Go off the chart here because this is my last statement, and we're going to kind of end this show here today. What's my overall take? I told you pre-show, don't get wrapped up in the volatility of price action during the actual event. I don't know why. I don't know how. I can't tell you the ins and outs of it. All I can tell you is in the 5 years that I have been trading these markets, in the 5 years I have been watching FOMC meetings live, especially during very, very important ones dealing with big cuts or big hikes. Volatility is crazy, and it doesn't really settle down for a couple of hours, up to 24 hours after FOMC. I have also found, not 100%, but more often than not, let's call it 75% just because I don't see the data right in front of me, but I'm going to say 75 to 80% of the time when you fall coming into the FOMC meeting, which is what we've done this week, 75 to 80% of those times we have ended up leaving FOMC to the upside. On the flip side, when you rally into it, 75 to 80% of the time, you end up falling afterwards. Nothing in that meeting While the mood might have seemed bad, while some reporters clearly were trying to get some gotcha answers out of him, nothing in that meeting was actually bad other than the fact that Jerome Powell didn't want to answer questions. But when you look at the actual details and you look at the things surrounding the situation, this meeting went kind of what I expected in the sense of we're getting more rate cuts. Liquidity is coming. The whales have retail investors right where they want them, where you are too scared to go buy right now. That's exactly what they want. You want to know why? Less competition for them to scoop up more cheap prices before the next move to the upside. But everything right now, unless a massive change happens, unemployment's not out of control. Inflation's not out of control. We are cutting rates and we have more rate cuts coming. All of those lead to one thing: bull market is still coming. Guys, if you enjoyed the show, make sure to smash the like button. We will not have a Friday show. We have a special business meeting we have here with a couple of the leaders in the team, but we'll be back on Monday. At least May and I will be back. I think Shrum will be traveling, but we love you guys. We'll see you around. See you next Monday. Adios.
Yeah.